the majority of all of our borrowers that we lend to are going to be self-employed. So these are going to be business owners or independent contractors or anybody that operates maybe on, as a sole proprietor and files a Schedule C. Most of these borrowers have, they take advantage of a lot of different tax write-offs, that they get through being self-employed. So a lot of them just don't show enough income on their tax returns to be able to qualify the conventional route, by showing their full 1040s. So having alternative options for them, we qualify them through bank statement programs, P&Ls. We have a 1099 program, where instead of looking at tax returns, we'll look at more cash flow and what their business actually generates, from a gross sales standpoint. And we can qualify them, just looking at those documents. And then another big side of what we do is going to be for all those real estate investors. So you have a lot of real estate investors out there that have, portfolios of properties that they own. And when they try to go qualify the conventional route, it's just a lot of paperwork documenting all their different rental properties, taxes and insurance, lease agreements, expenses that they write off on all those properties as well too. It can be very challenging for those borrowers to be able to qualify the conventional route. So again, instead of qualifying them with tax returns, we just look at their individual properties and how they actually cash flow using their rental income. So it's just a lot less income documentation, and it's a much easier program for those borrowers to get financing, much more efficiently.
But they're not those no stated income loans though, right?
Yeah, they're not stated income. So, anything that's going to be owner occupied, meaning if a borrower is going to buy, purchase or refinance their primary residence, we're still showing their income, and we're still running a debt to income ratio to make sure that, they qualify from that standpoint.
Right.
The only difference between what we do and what conventional lenders and banks do is, instead of looking at tax returns to determine what their income is, we're going to look at their bank statements, or we're going to look at their P&L for their company, or even just a 1099 statement to show, what their business is actually bringing in from a gross sales side.
And how do you collateralize those? Because if you go to a conventional lender, you're probably borrowing on real estate, and they put liens on those.
Yep.
What do you guys do for that, for collateral? Are you doing UCC filings or combination?
Yeah, no, we do the same thing as conventional lenders do. So, our collateral is going to be the property itself. And, all of our loans that we make are going to be in first position, on a piece of property. We don't do any seconds, so we just do all first liens. And, the value of the property in relation to how much we're lending, if your LTV is a big part of what we do as well too. Our average LTV typically falls around 65 to 70%, on the bulk of our pools that we lend on. But yeah, we're first position on all those individual deals.